NASDAQ following suit here to kind of have all the major averages opening lower across the board. The NASDAQ lower by about 0.5%. This follows what was kind of a pullback yesterday and what snapped a two-day winning streak for the markets already. We'll see how the markets kind of gauge today. But so far, again, across the board, negative territory. For more insight on early morning trading activity, we're going to bring in Michelle Schneider, partner and director of trading research and education for MarketGauge.com. Michelle, markets opening up lower across the board here after breaking a two-day winning streak on Wall Street. Is there any indication in terms of the activity that we've seen this week or as of late that we are at the bottom of this bear market? Or are you with the consensus of most of my guests that I've had on the last 2 weeks or so who say there's plenty of bottom to go?
Well, what's interesting is that the 3,800 level in SPX and the S&P futures held exactly, and it was a measured target. It's something that we had talked about, went to 3,805, so we were off by 5 ticks. And so the question really is going to be, what would be the catalyst to break that and break that hard? And we have certainly many things around floating besides, obviously, the inflation concerns with CPI coming out tomorrow. We also have the Fed very much committed to raising the rates, and now Europe is supposedly joining on that. We have fears of recession because you have stores like Target now all of a sudden with tremendous amount of inventory and people really holding back on buying anything that they need. And yet at the same time, you'll have, even though jobless claims ticked up a little bit, you do have some brighter signs in the economy. So the question is really going to be, since we know that we have a lot of institutional selling, is what's going to happen if we can't hold. I don't even think we have to wait to see if the bottom is going to break to say we're going to go lower. I'd say we'll know in the next couple of days. If we can't really hold, let's say, in the S&Ps above 4,090, then I would say that we're probably going to have another retest and very possibly go lower. I don't like to get too extreme because the theme very much this year, and will continue for a while, is a trading range. So people are constantly looking for this incredible whoosh to the downside or rally to the upside. What if we just sort of go a little bit lower and then get stuck there? And I think that's kind of what we're seeing.
So if we're testing a new bottom in the next couple of days, according to kind of your thoughts here, what's the catalyst for that? Is it the CPI read that we get out tomorrow?
Well, if the CPI read is softer than what's expected, we actually might get a rally, hence the trading range.
Yeah.
We'll maybe test some of the upper regions. If it's more than expected, then I think it will spook the market. Is it enough to get the market to really break down under the lows? Right now, you have an overriding philosophy that the Fed, as much as they're saying that they're committed to fighting inflation, and of course next week with their meeting probably will rise by another 50 basis points. The question is really going to be to how far will they go at the risk of really killing the economy? And I think that's really what's going to keep the market from totally collapsing until they see more evidence of that commitment.
It's interesting because I look at tomorrow's read, and of course there's a lot of hope that we see a read that shows inflation is peaking or has peaked already. However, the reality is that's not necessarily all the good news, because even if inflation peaks, if it holds steady, that's still a painful experience over the course of what could potentially be a year or so. And to that effect, we've got a lot of data out this week, or a lot of kind of forecasting out this week. The Organization for Economic Cooperation and Development, or OECD, is cutting its global growth forecast. You also have the World Bank signaling that as well over the last 24 hours, which is fascinating to me because on one side, that is good news for inflation potentially, right? If we see some slowdown, that is exactly what we needed in order to curb inflation. But that being said, a slowdown could mean a recession, and there is a fine line, it seems like, between the two. How do the markets continue to read this dynamic? How do you think this actually ends up netting out?
Well, there's so many factors involved. And by the way, you make a great point. But some of the factors that are involved are PE valuations versus where commodities still are. So regardless of what happens, and I totally agree that a plateau is not the same as going lower in terms of prices. And of course, we have to also realize that the CPI excludes the two things that are the most essential, which is oil, energy, and food. And I do believe, in fact, I just read again, we're looking at more drought in the growing regions. The crops have already been lower than expected. Oil reserves are actually down. So I don't think those two areas are something that's going to soften anytime soon. But getting back to the PE valuations, particularly in some of these big tech stocks, they have been overblown in terms of their valuations for years, lots of stock buybacks. And so when people are talking about fair value, that's the part I think is the most frightening, is I don't really know if the market knows yet what exactly fair value is, given this new interest rate environment, given this inflation environment, given the fact that we're seeing slowdowns, given the fact that the job market is sort of kind of weird in terms of the numbers. It looks good on paper, but we know participation rate is really bad. And given the fact that a lot of these companies for the next quarter earnings are really going to start to see the pinch. So yeah, there's a lot floating around, and I think people have to be really careful about calling a bottom and have to really kind of adjust their investment strategy here. They should already have gotten out of a lot of the big growth stocks, but adjust their investment strategy if they want to be more involved on a retail investment basis, is really think you buy the extremes when they go down and settle, you get out as soon as you get a good rally, and that's kind of how things have to be. And if you want to look out longer term, if the things really get crazy, particularly with food and oil, that's really where I think the precious metals, which have been so underperforming, could really start to shine.
So you highlight, obviously, a trader perspective in kind of playing the momentum game right now, and it could be an interesting time to play the momentum game right now. In terms of that longer-term investor who is looking at this market and trying to sift through, is this a buying opportunity? You know, we never want to have them trying to catch the falling knife or kind of, you know, trying to really call the bottom, so to speak here. How does the longer-term investor, though, look at this market and approach potential opportunities?
Well, the long-term investor has already had issues with the 60-40 portfolio, which clearly, with bonds not really doing very well, has been a disaster. They're also been told that buy good companies with good balance sheets, you'll never go wrong. That's also been, I think, a very dangerous narrative. So if you're a long-term investor, hopefully you've already liquidated a lot of the stuff that you were in that was starting to lose money when we were first turning down in March.
Yeah.
And at this point, maybe sitting heavy in cash. I think that you really have to wait now at this point, possibly for a while. That's what stagflation is about. If you look back at the last time we had stagflation, there was a trading range that persisted for years before we started to see go from a really deep recession after Volcker jacked up the rates into, you know, more of an economic growth environment. So I'd say as a long-term investor, you have to be really careful what you're getting into, and it's okay to kind of sit in a little bit more cash than usual and then put that money to use when the coast is clear, but don't push it, and don't buy the narrative that, you know, good companies will just always do well, because that's not true, because we don't really know what fair value is. That's back to our other conversation.
Such good insight there. I mean, I think we always think with the mentality to kind of play the market, but sometimes pulling back, holding on to cash amid these kind of wild swings and pullbacks may be the most beneficial thing to do. Michelle, before I let you go here, I want to get your thoughts on, obviously, news out this morning. SEC Chairman Gary Gensler unveiling a plan to overhaul payment for order flow. That's a method obviously used by Robinhood. We learned that over the last 2 years. If people weren't aware, they really got really familiar with payment for order flow. What are your thoughts in terms of what this means for the retail trader? Because on one hand, some are saying this protects the retail trader, albeit 2 years probably late in protecting the retail trader. But on the other hand, some are saying this will kill the retail trader, because the whole premise of them getting into the market was being able to do so for what they thought was free.
Yeah, and it's so complicated because it really brings into question the whole idea of the free market. And as we know, once we get into more regulation, the whole idea of the free market becomes compromised. And so, yeah, on one level, obviously the retail investor paying 0% commissions were shocked to find out that their orders were being sold. And therefore you had algorithmic trading around that, and it was actually, you know, really wreaking some havoc. But, you know, this is not a new thing. It just looks different now because it's more publicized. But I go way back, and on the commodities exchange, back in the day, you had people jumping orders. You had people knowing what the order flow was going to happen before. And that's where the locals came in and added some liquidity, and also, you know, kind of screwed around with the price.
Yeah.
So I would actually caution too much over-regulation when it comes to that. And you certainly don't want to really squash the retail investor.
Yeah.
Let the market do that. I mean, obviously that's doing that right now, but let them learn from that as opposed to having to deal with more government regulation.
And to your point, this has been around for quite some time. The retail trader got introduced to it about a year ago with some of those hearings on Congress, and they've still been active in the market, so they're able to kind of understand it enough to still participate. We'll end up seeing where this goes, but it's really interesting that it's coming out now. Michelle, as always, such great insight. Really appreciate having you on again. Michelle Schneider, partner and director of trading research and education for MarketGauge.com.